the lies they have been telling you about value investing practiced by Warren Buffett and Peter Lynch. We want to start this episode in understanding alpha. Now, alpha, often considered as the active return of an investment, measures the performance of an investment against a market index used as a benchmark, since they are often considered to represent the market movement as a whole. The investment could be an actively managed fund or stock pickings or trading using the principles of value investing, with or without technical analysis. The excess returns of an actively managed fund or stocks picking strategy relative to the return of a benchmark index is the fund's alpha. For example, if you are a stock picker and your annual returns for that year is 20%, while the market only performed 15%, so your alpha is actually 5%. Now, the conventional wisdom has always been that Warren Buffett's success can be explained by his stock picking skills and his discipline, meaning his ability to keep his head while others are losing theirs. However, in a 2013 study, Buffett's Alpha, authored by Andrea Ferzini, David Cabela, and Leslie H. Peterson, provide us some interesting and unconventional answers. The authors found that, in addition to benefiting from the use of cheap leverage provided by Berkshire's insurance operations, Warren Buffett bought stocks that are safe, cheap, high quality, and large. The most interesting finding in the study was that stocks with these characteristics tend to perform well in general, not just the stocks with these characteristics that Buffett buys. High quality companies have the following traits: low earnings volatility, high margins, high asset turnover, low financial leverage, low operating leverage, indicating a strong balance sheet and a low macroeconomic risk, and not to mention low specific stock risk. Companies with these characteristics have historically provided higher returns, especially in down markets. In other words, it is Warren Buffett's strategy or exposure to factors that explain his success, not his stock picking skills. The three authors of the studies in 2014, Betting Against Beta, found that once all factors like market beta, size, value, momentum, quality, and leverage are accounted for, a large part of Buffett's performance is explained, and his alpha is statistically insignificant. Again, it is important that this finding does not detract in any way from Warren Buffett's performance. After all, it took decades for modern financial theory to catch up with him and discover his so-called secret sauce. And being the first among the first to discover a strategy that beats the market is what will buy you a yacht, not copying the strategy after it is already well known and all the low-hanging fruit has been picked. With that said, the findings do provide insight on why Warren Buffett was so successful. His genius appears to be recognizing long time ago that these factors work. He applied leverage without even resorting to a fire sale, or since he's very disciplined, he stuck to his principle. Buffett himself stated in Berkshire's 1994 annual reports, Ben Graham taught me 45 years ago that in investing, it is not necessary to do the extraordinary things to get extraordinary results. Secondly, it is worth considering the case of Peter Lynch, generally considered as the greatest mutual fund manager of all. Peter Lynch joined Fidelity in 1966. It was not until 1977, 10 years ago, that he was given the responsibility for the Magellan Fund, which was not even available to the public until mid-1981. Before that, it operated as the private investment vehicle of the Johnson family, which are the Fidelity's founders. From the time when the fund was available to public all through until mid-90s, Peter Lynch outperformed the Standard & Poor 500 index by 6% points per year. Peter Lynch started with about 100 million under management but ended up running 16 billion. The original small cap fund had not only had become a large cap fund, but it also eventually owned 1007 stock. While Lynch did not generate alpha even over the later part of he managing the fund, the size of his outperformance deteriorated, okay, where just as we should expect. Now, over the last 4 years, Magellan, the final 4 years, okay, when he was still managing the fund, the fund managed to beat the S&P 500 index by about 2% per year. Still a very great performance, although not as legendary as the one that might be explained by random good luck. Perhaps Lynch purposely retired from managing the fund in 1990 before the game was up and the market forces caught up with him. He may have recognized that because of the market efficiency and hurdles to outperformance made higher by closer indexing, market impact costs and other burdens of active management, the odds of his continuous success were not very good. So if you are the top in your game, why not go out at the top? And that is just the logical thing to do. While we will never know how Peter Lynch would have done if he had continued to run the Magellan Fund, his carefully handpicked successors all failed to deliver significant alpha. Now let's shift our focus to John Bogle, who founded the Vanguard Group, now the largest mutual fund company in the United States. He started the first index investment trust, later renamed the Vanguard 500 Index Fund, in December 1975. And in the June of in the following year, a story actually appeared in the Fortune, okay, to highlight what he was doing. So, and that actually make a lot of people criticize him. Now, philosopher Arthur Schopenhauer said that all great ideas go through 3 stages. In the first stage, they are ridiculed. In the second stage, they are strongly opposed. And in the third stage, they are considered self-evident. And this was certainly the case for John Bogle. When it was launched, his very first index fund was launched, it was heavily criticized by the mutual fund industry back in the 70s. The chairman of Fidelity, Edward Johnson, assured the world that the company has no intention to follow Bogle into index fund when he stated, "I couldn't believe that the great mass of investors are going to be satisfied with receiving just average returns. The name of the game is to be the best." And another fund manager, the National Security and Research Corporation, rejected the idea of settling for the average. Who wants to be operated by an average surgeon, he asked. And that refrain that indexing and passive investment in general will not only get you average returns became one of the big lies told by Wall Street. And lastly, let's talk about Ray Dalio, an American investor, hedge fund manager, and a philanthropist. Dalio is the founder of investment firm Bridgewater Associates, one of the world's largest hedge funds with over 150 billion of asset under management as of the time of this recording. And let's look at one of the news pieces that was published about what he said in Business Insider. You see here, he said, "You won't beat the market." He said, "Unless you're one of the greatest investors on the planet who happens to be also very lucky, you are not going to craft a portfolio that brings you a higher return than had you just tracked the market's long-term growth with an index fund. Before you try to beat the market, recognize that the likelihood of being successful is extremely small, and ask yourself if you spend the time to train and prepare to be the few that who actually wins." Okay, and here's another separate article which I highlighted. He said that his firm, okay, Bridgewater Associates, spend hundreds of millions of dollars each year to try to beat or outperform the market, to try to get that alpha that every investor is searching for, try to understand it, beat it. Adding that many other sophisticated investors and institutions are doing the very same thing. Those are the poker players that you have to play against. You are not going to be able to do that. So next, I am going to tell you, if you still believe and you still have very unwavering conviction that by stock picking you can outperform, you can get an alpha and outperform the market by a significant margin, I'm going to tell you how by doing so you involuntarily become a victim in investing and lose money in the process when you do your own stock picking. So stay tuned for that.